Good afternoon and welcome. My name is Heidi Martinez, and I am the Staff Assembly President. Today, we have an exciting Learn at Lunch session featuring experienced financial representatives from University Credit Union. The goal of our financial wellness series is to enhance financial literacy among UCLA staff, empowering you with the knowledge to make informed financial decisions. This is the second of four Learn at Lunch sessions, and we are thrilled to continue to provide valuable resources. Mark your calendars. Our next session is scheduled for March 25th, where we'll dive into investing in real estate and home buying. To stay informed about upcoming events, be sure to subscribe to our newsletter and follow us on social media. Thank you for being here, and let's get started. Our first presenter is Megan Sterling. Megan is a strategic, motivated, and dependable financial wellness coach with over 2 decades of experience in higher education. Her diverse background includes roles in admissions, outreach, training, and onboarding, showcasing her innovative approach and keen eye for identifying opportunities to drive institutional growth. As a senior growth officer for the University Credit Union, Megan applies her expertise to engage students, staff, faculty, and alumni, providing practical financial guidance and support to promote financial literacy and well-being. Megan's credentials include CCUFC certification, Salesforce expertise, and a bachelor's degree in finance and marketing. Dedicated to fostering a culture of financial resilience and literacy, Megan is committed to empowering individuals to achieve their financial goals and enhance their financial health. And second, our presenter is Coley Curtis. With over 17 years of experience in the finance industry, Coley has built a remarkable career dedicated to empowering individuals through financial wellness. As a growth officer at University Credit Union, Coley leverages her extensive knowledge and expertise to drive member growth and engagement. Throughout her career, Coley has had the privilege of serving members across financial institutions of all sizes. Her unwavering commitment to credit unions stems from a belief in their ability to make a positive impact on their communities they serve. As a certified credit union financial counselor, Coley is passionate about guiding members towards financial success and stability. Coley, Megan, thank you for being here. You may begin.
Thank you so much, Heidi. Thank you, Staff Assembly, for having us. We really appreciate the opportunity to do what we love. So Megan and I are here to discuss 10 steps to financial success today. And we, of course, hope you all take something with you that's going to improve your financial future. That's why we do what we do. The possibility of just having an impact, keeps us here. And this is the favorite part of our job. So thank you. Thank you guys for joining. Now, I wanted to share a little bit about University Credit Union. We are unique in the credit union space, especially for UCU employees, staff, faculty, alumni. We actually were started on the campus of UCLA in 1951. By employees of UCLA. So you guys are our home. That's where we were born. You hold a special place in our heart, as do all of our members. But we believe that makes us uniquely positioned to serve you. And through the presentation, we give unbiased advice, but we will be talking about kind of the special things that University Credit Union has, especially as an example to kind of back up our tips. While we're presenting, if you guys have any questions, please type that in the chat. I'm going to have Heidi watch and Megan watch, and we'll try to answer questions as they come up. And then at the end, we will have a Q&A session. So you'll have some time to go ahead and write down your questions. We'll address those at the end if we don't get to them right away. And yeah, just take good notes. We're going to offer you guys opportunities as well to meet with us virtually. You guys also have locations on campus and in Westwood on Sepulveda. So you guys are kind of uniquely positioned for us to give you some wraparound service. So here we go. Again, we serve students, employees, retirees, alumni, and your family. So if you're a member of University Credit Union, that is how you can join. We're not open to the public, which means that we do offer certain products and services and perks that are geared towards the university community. We serve without conflicts of interest. About 93% of our staff are certified credit union financial counselors. Even non-member facing, staff members in accounting, that's how important it is to us that we continue to offer you guys this enhanced benefit and just kind of, make sure that you know that we're here for you. So we're, non-commissioned. Some other banks you will find, people making recommendations for reasons of commission or other reasons, but it's just business structure. So we're full service financial institution. We're not for profit and we're member owned. So that's kind of what sets us apart here. Moving on. So like I mentioned before, the difference between a credit union and a bank, many of you guys have banks. I also have a bank. And then I have two credit unions. So I'm a credit union collector, but University Credit Union is my main. We generally have lower fees or no fees compared to banks. Often our rates are higher for savings products and our rates are lower for lending products. And we have a community focus. So like I mentioned before, we have, a big heart for our university community and offer you guys some special things that are geared towards you. Oh, move on here in just a second as soon as my mouse works again. Hey, Megan, can you advance this slide? Thank you. All right, so without further ado, I'm going to let Megan kick it off with our 10 steps to financial success.
Thank you, Coley. Thank you, Heidi and Michael, for having us again with your financial series. So our topic today is 10 steps to financial success. And really, what is financial success? What does that mean? And that can have lots of different meanings for people. Really, what it is, it's being in control of your money. And money is a very personal topic. Most of us get our financial relationships or how we deal with money from how we were raised, from our families. But it can also come from our friends and our social lives and what's happening in the world, whether it's political or cultural. So our financial success is being in control, but it's really where it starts for you. And money and how we not only spend it, but make it sometimes requires us to do a little bit of soul searching onto who we are. So that really leads us into this next slide, which is our money personality. What is your money personality? What does that mean? How do you know how you are with money? And it's very personable. Some people love to talk about money, other people do not. Even different genders deal with it very differently. So, in order to kind of figure out what your money personality is, do this little exercise, and we will share the slide deck with you so you don't have to do it right here, but list the products and services you spend money on. Are you a good spender? What does that even mean to be a good spender versus a bad spender? And changes you'd like to make in your spending habits. So this is the get real activity on how you deal with money. Once you've done this, you'll start to see some patterns that come about, and that will lead to your money personality. Go ahead, Coley. Okay, so these are some of the different personality types that are out there. And believe me, you're probably not 100% one of these money personalities, but a series of them. And there are no right or wrongs when it comes to your personality. And so they're not bad. Like I know there's a TV show called Hoarders where you see their crazy homes and how they store all those things. But a hoarder with your money is a little bit different. They like to save, budget, prioritize. After doing some self-reflection on my own money habits, I came up with three that really resonated. My biggest, strongest one, about 60% of my personality, is the risk avoider. I go for the sure thing, which leads me to the other two I am, which is the hoarder. I'm about 20% hoarder and 20% spender. I like to have my fun money. I work hard. I also want to spend some of it. So figure out who you are. Do the soul searching on this topic of money. This will help you to know who are you with your money. We've all made money mistakes. That's okay. That's sometimes how we learn best, is by making a mistake. And then you can really start using the tips we're going to share for your financial success. But talk about it. If you are in a relationship, make sure you're on the same page with your partner and understand each other's money personality. Go ahead. Okay, so step number one, establish your goals. What do you want to do with your money? What is your plan? Now, I always say, when you set goals, what do you do with those goals? Where do you put them? Do you keep them up here? Do you write them down? Do you share them? Do you reevaluate them? I like to write them down. It helps me to be a little more accountable to them, and also revisit them because they are going to evolve over time. Be specific, but most importantly, be realistic. Go ahead, Coley. Goals go into two different categories: short-term, long-term. Now, we all know the big long-term: retirement, housing, all of those. Short-term, it could be on the short-term list as well. A lot of times we're always thinking about money as for the future, which is great. There's nothing wrong with that. But what if you want to go to that great concert that's coming? Or you want to go to that sporting event, but that really isn't your budget. It's okay to have fun things in your budget as your goals as to what you want to do with them. So list everything that you would like to do as far as a money goal goes. Goals, make sure they're SMART. This is similar to what I said earlier: specific, realistic, measurable, attainable, timely. Make sure you put a timestamp on it, because it's easy to go, oh, you know what, I'm going to push that out to 3 more months and 3 more months. If you make them timely, you'll see success over time. So SMART goals when you are doing the planning out there. Okay, so that's the first step: establish goals. Second step, take stock of what you have. Know what you own and what you owe. So if you have a house, write these things down, and this will help you to establish a good, strong starting point. Have that net worth. Your assets can include savings, cash deposits, investments, equity in your home, your car, anything else that you may have. Liabilities, debt, credit cards, student loans. Write them all down. Figure out what your net worth is. This is not a budget. Some people get those confused. This is your net worth. Where are you currently at? What's our starting point? Go ahead. And now you can create that spending plan, which is the budget. What's coming in and what's going out every single month. Write it down. There are so many great resources to creating a budget. Some people like to just do a basic spreadsheet. There are thousands of apps that you can use. They have all different levels, from free versions to versions that you can pay for that will import your bills, and you can watch it like that. You can even buy a budget spreadsheet off of Etsy and customize it to what you like. But know what's going in and out. Now, the rule with budgeting is 50, 30, 20, 50% towards needs, 30 towards wants, 20 towards savings when you're doing it. Out of that 50 towards needs, about 35% of that should be your housing, whether that's a mortgage or rent. That's the easiest way to kind of figure out if you're in the right ranges. Now, stay away from what I always call the lifestyle creep. If you pay off debt or get an increase in income, you may be tempted to spend the extra money. At those times, reevaluate your budget. It may be a time that you are achieving a goal that you had in the last step. So be careful of that when you do it. Okay, creating the budget. We talked about that and how to do it. Do what works for you. If you're in a relationship, get on the same page with it. It's one of the top 3 reasons couples break up is money. And let money work for you, not against you. Let it be a tool that brings joy into your life. And it can. And everybody always says, oh, if I just made more money, it would solve all my problems. And it actually just adds more problems because you have bigger decisions now to make. So if you learn the habits early and you start working with them, it does become very successful for you. The one thing I don't want you to do with your budget is have budget busters. And what does that mean? That means, do you ever buy something and then you have a little bit of buyer's remorse? So ask yourself, do I need it? Do I need it now? What would happen if I didn't have it? And how do you avoid budget busters? I know for me, like Amazon is a big one, and some of you may agree with this. And so I like to put things in my cart, and then I come back 24 hours later and I decide, do I really need that? Is that a want or a need? Where does that fall into my budget? If anybody has any budget buster tricks, please put them in the chat. I love TJ Maxx, so I always get a cart and I put things in the cart. And then by the time I get up to the checkout, I go through the cart again and I'm like, want or need, or did I just really like it? What is the purpose of buying that? And usually I can save some money by avoiding that. But it goes back to your money personality. Who are you? How do you spend money? How do you save money? And that will help you to stay on track with your budget buster. Okay, I'm going to pass it back to Coley for number 4.
Megan, I didn't know you were a Maxinista. Now I know what to get you. I'm going to buy you a discounted gift card on our website and give that to you for Christmas. All right. And then she's right. More money, more problems sometimes. But step number 4 is live within your means. So what we mean by that is increasing your income and prioritizing your spending. Now, I know what you're thinking when I say increasing income. That doesn't always mean making more money based on your position in life, right? So getting a raise or a promotion at work is not, the next step for you finally making more money. I find that a lot of my members are not making sure that they're earning as much interest as they can. So interest income can help you, with hundreds or thousands of dollars a year, depending if you're making sure to maximize checking accounts that pay interest, a high yield savings account that's earning interest. Right now, our high yield savings at University Credit Union is earning 3.5% annual percentage yield. And then I have interest, intention, and ideas here. The intention part to me means that you're intentionally paying attention to your finances. You're making sure you have a financial wellness review at least annually. Even bankers have bankers. I meet with one of my coworkers, like Megan, who has different life experiences than I do, or maybe some strengths that I like to get some ideas from them every 6 months. And of course, on demand, if your life does change in a way that's going to affect your finances. So if you're planning for a family or you need to buy a car, Those are other good reasons to make an appointment and reach out to your financial professionals. And then the ideas portion, above and beyond meeting with a banker, we won't go into taxes too much because we're not certified tax professionals, but there are some ways that your tax professional could potentially help you reduce your taxable income, which would be, you getting to keep more of the money that you earn in your pocket rather than paying that out at the end of the year for taxes. So I mentioned wraparound before. I really like to see my members, I like to make sure they have a tax advisor. It's not all that much of an expense compared to filing taxes yourself if you're using H&R Block or TurboTax. Not having a tax professional can also be a way to save money, but personally, I usually recommend that you have one just to make sure that you're taking advantage of everything that you can. And then prioritizing spending, just like Megan mentioned before. So we're going to want to reduce our spending if at all possible. I know you probably hear this all the time, but I spend about $100 on Starbucks a month if I'm not careful. I'm very generous and I like to buy people coffee. And I have my Starbucks reload coming out of a specific card that I use at UCU so I can see exactly how much I'm spending and feel that pain. And then that helps me reduce my spending for the next month until I stop paying attention again. So just always keep on top of yourself. Substitute when at all possible, instead of buying the name brand, maybe you can get away with buying, the non-name brand to save some money. Postpone your spending until you're ready. For example, if you're planning a vacation and you want to go now, which of course we all do, it would benefit you to sit down and say, you know what, if I save this much for this length of time, I could go on this vacation comfortably and it wouldn't pinch me in my cash flow right now. So those things are difficult to do, but I promise if you put some intention behind it, you'll start seeing results. And that's something that you could see a result the first week, the first month. So that's number 4. Step number 5 is going to be pay yourself first. There are different camps on this. So what I like to see people do is not wait. I'll get to my next slide. Start saving today, even $1 a day. You'd be amazed at what can happen with compounding interest. So if you were earning money on your savings, that interest then earns interest. And then the longer you have that in there, the more interest you're going to earn. And that really sounds like a slow way to do things, but if you're saving money for long-term goals, you're going to see that benefit by the time you're ready to take that money out for your specific goal. We like to see at least 10% of your income going towards your savings. 20% is better, but you have to start with where you are. Some people have 99 savings accounts. They want to have one for everything. And they, will split up their 20%, but just know the basic math of how much of how much you're spending, how much you're using for living expenses, and then how much you're saving. And then, of course, just that weighing the instant gratification against the ultimate gratification, which you've heard. I'll try not to, keep dwelling on that, but I promise you it's worth it. And like I mentioned, don't wait. So if you start now, you could put an auto deduction in place. And I've literally had members go $1 a day and they just have $1 transferred to their savings account every day. And then if you can do more, which a lot of you can, hopefully you can go ahead and decide how much you want to put into your savings account on payday. So you maybe never see that money. I have people put their full paychecks in their savings account and then only transfer out what they're going to need for bills. So there are different ways to do that, but generally speaking, if you're paying yourself automatically, it's going to, work out better for you discipline wise. And then, of course, I mentioned compounding interest. So compounding interest, it's what's going to make your money make money and faster. So always make sure you're taking advantage of your savings account. Make sure you're earning a good interest rate. Most banks, I think the national average right now is about 0.05. You'd really be amazed at which accounts you have that you didn't know were really not earning any interest. And just moving that account to something that is earning interest can be motivating. So you'll see those dividends, and that'll make you want to invest more into that savings account. And of course, your future is worth spending a little bit less today if you can, but there's a good balance. We want you to have fun too. The general rule there is 50% on your living expenses, 30% on, having fun and, doing vacations and otherwise just enjoying your money. And then what we like to see here for the savings plan would be the short term, the medium term, and the long term. Short term is going to be your emergency savings. Have a dollar amount for that. Think to yourself with insurance, my current savings, my income, how would I pay for something? Say that I had a, $10,000 emergency. Is that even possible? How much do I need to have ideally between 6 and 9 months of emergency savings to get myself through in case of a job loss or something else of that nature? And then above and beyond that is the medium term. So we like to see with your savings account, and then semi-liquid would be maybe a short-term certificate of deposit where we have a contract term associated with your savings account. If you withdraw early, you may receive a penalty. But if not, that money is going to enjoy a higher interest rate traditionally than a savings account. And then long term, you can do long-term CDs. You can meet with, an investment advisor. We have an investment advisor here named Lucy. She's fantastic. She's free to our members, even our non-members, to discuss things with. But the professionals there are going to help you maybe discover retirement, tax deferred, in accounts, education accounts, things of that nature. So I always recommend, like I said, getting professionals involved where you can. And then what I wanted to do here is just kind of illustrate the power of time. So the longer you wait, the less time you have to have that compounding interest kick in. And like I said, 15 years is a long time away. If we were in the grand scale, scale of things going for 1 year, it would be smaller, but you can start to see where you really, really will see a discrepancy here. So in this scenario, we're about 70,000 as opposed to 150,000. There we go. And then step 6 is going to delete your debt. So I know that that sounds extreme. I know that that seems impossible in your mind right when I say it. But some of the tips here are if you're spending too much on your credit card, which I think the studies show that you're more likely to overspend by about 30% if you're just not paying attention to what you're putting on that card because you know you have enough of an available balance in your credit line. So cash only for a little while. I've done it before. It kind of resets things. And it doesn't have to be cash, like the envelope system, though that does work for some people. Just use your your ATM card, your debit card. Cash if you have to. Just be careful about how much cash you're carrying with you. And then if you can refinance a loan or review your loans with somebody like myself who would help you determine if it pays for you to reduce the interest that you're paying on your loans by refinancing. And then increasing payments. If you have the wiggle room, you can do calculations. There are some tools on our website. I can do them for you, where if you increase your payments, you'd really be amazed, especially on a mortgage payment, for example, where that's probably the largest loan that you'll ever have, on how quickly that saves you thousands and thousands of dollars on interest. Even just like a $50 principal payment. Everybody should hopefully have some wiggle room in there. And if not, we should talk about consolidating. So you do have that wiggle room. And then the aggressively repaying your most expensive debts. That is how some people like to approach things, but there is a psychology there. If it would benefit you more, emotionally and just to pay off the little credit card and get that out of the way or consolidate and have one payment, which a lot of people decide to do, and then just pay that down as fast as you can in balance with the rest of your budget. There we go. And then I wanted to share this QR code with you. We do have a lot of benefits on our website. And so there are lots of tools, calculators, like I mentioned. I'm going to show you the credit tracker that we have. What we have here is just an illustration of $18 million in financial benefits. That's broken down by savings and interest, interest paid and dividends, other added value. And we have that at about $347 per member per year. In a household of just over two people, we're looking at $730 per household. And that's just the average. So basically, depending on your financial snapshot, that could be even more. And that's just an example of University Credit Union. But if you decide you're not going to bank with the University Credit Union right now, or you already have your established banking benefits, I want you to schedule a meeting with your financial advisor if you have one. Just kind of see what services they have to empower you, see if you can get a better interest rate there, see if you can refinance your loan there, and then get a couple of different opinions. So you can shop around as a credit union member, as a bank member, just to make sure you're actually saving that money. All right, and then we have analyzing your credit score here with the credit journey that I mentioned. So this is just another tool that we have on our online banking portal. So you will get your credit report score, which is fantastic. It's a good indicator of where you are, though it is not your exact score for a loan application, which lots of people are surprised by that when they go to apply for a loan, but it is a really nice health indicator. We also are going to show you your payment history, your credit age, give you tips on how to improve your credit. You're going to be able to see on a simulator what would happen if you decided you couldn't pay your bills that month, or if you paid off a loan, and then also set goals. So I think this is a really powerful resource here at University Credit Union. And if your bank has one of these as well, that may be something to consider, or another credit union. And then speaking of credit report, a lot of people also don't know this, though more people are catching on. You are legally allowed to obtain one credit report per reporting agency per year. This is the only website that any bank or financial institution should be recommending to you. It's annualcreditreport.com. You can also call them or write them. For example, I use this benefit by checking my score with one agency, or I'm sorry, my credit report with one agency in the beginning of the year. I do it again in June for my birthday. And then I do it again at the end of the year. And this just helps me make sure that there's nothing on my credit report that wasn't me or that I need to dispute. You'd be surprised sometimes at things that can pop up. I've seen identities get confused and somebody else's credit report being dinged for, a data entry error somewhere at some financial institution. So that's just a good thing to do. I know that there are other websites out there, but this is a tried, trusted, and true resource. There we go. And then along with that, the credit score breakdown. So if you're not familiar with what makes up your credit and what can affect your credit the most, the payment history is going to be the big thing. And now I'm a good banker because I've made all the mistakes for you. I will say that just missing your payment on one credit card, the minimum payment, you can pay for that for up to 7 years. It's just really not fun. So if anything, go ahead and pay the minimum balances on your accounts and pay them on time. Now, 30% is the amount owed compared to your credit line. So if you have a $100 credit line, you want to try to stay at $30 or below. So 30% of your available balance being used looks fine. Anything above that, we want to try to pay that debt down to improve your score if you're trying to get approved for something. Length of credit history, this is something people think they can't do anything about, but it definitely is. I work with a lot of students at the UCs, and I always say, get an overdraft protection line of credit, even if you don't want to start with a credit card. And then when you're ready, you can do a credit card, but this is going to ensure that you start building your credit sooner than later. And then a tip is to never close your oldest trade line. So what can happen is that can shorten up your credit history. So if you get a letter saying that your credit card is going to be closed for inactivity, but you've had this credit card for 15 years, you may want to try to use that ever so often just to keep that credit line active. And that's what I mean about unbiased conflict free advice. We're never going to say, yes, close all your credit cards and come to University Credit Union. We just really want what's best, what's in your best interest. Types of credit used, your credit mix. So if you have all credit cards, which some younger folks make that mistake. They only have credit cards. They, have never had a car loan or any kind of a personal loan. Um, the creditors really want to see that you know how to manage multiple different kinds of debt responsibly. It's not worth going to get new debt for, but that is one way certainly that good debt can be used to build your credit. This is all strategy though, and so you will want to seek the advice of somebody. And then we talked about, oh,
Coley, I'm sorry to interrupt. I do have a question in the
yeah,
chat.
fantastic.
How would you suggest we calculate emergency savings? Is it the same amount as monthly expenses, including payments toward debt, or are there other things to consider?
Yeah, I like that thinking of, best case scenario, if I lose my job, I need to take 3 to 6 to 9 months, if possible, of all of the money that I use to pay my mortgage, to pay my debt, right? So if I have a credit card balance or a home equity line of credit, um, it is important that you're able to pay those bills on time, ideally. Um, and saving just a little bit at a time will get you there. If you have AFLAC for, short-term, long-term disability, that gets a little bit more complicated. It's really what you think reasonably you'd have to pay out of pocket within the time frame that you would think you'd be able to get back on your feet or be able to get another job or whatever the case may be. So I hope that answers your question a little bit, and we can, discuss that more in depth at the end of the presentation, certainly. But that was a great question. And then here we go, just a quick little snapshot too of the bad debt versus the okay debt. Some people call it good debt, but it's okay. The best debt is not having any debt, but increasing your value. So home, business, education, those are all investing in yourself and in your future. Things that decrease in value, like clothes, meals, vacations, those are debts that you're going to want to avoid, if not pay off, sooner than later, because the interest rates also may be higher on those. And really, the abuse of credit causes failure. So fastest way to get yourself into a bad spot is take out debt for everything without consulting with a professional, and just getting over your head. And credit unions are also great. Specifically, you see that if that's happened to you, we serve, we do not judge. I spend all day talking to people about different ways that we can increase their credit score, get them out of kind of the hole that isn't necessarily their fault. I mean, there's deceptive practices out there, and life situations just happen and you have to live. So we're here to counsel you through that as well. And then this is just an example, like a balance transfer. If you're paying more than a certain amount on your credit card and you see a balance transfer opportunity, you may want to take advantage of that. So you'd want to take into account, how much do you owe? How much can you pay per month? What's your interest right now? And maybe you should do a balance transfer or a consolidation loan, which is just another way that we can help you. And I will mention that you don't have to be a member to make an appointment. So we're here, it's a mandate, that we help everybody in the community, whether they bank with us or not. So we're going to give you some links and some QR codes to make appointments and our email addresses. I want to hear from you. Right. And then step 7, buy a home. So especially the good debt versus bad debt we were talking about, renting does make sense, believe it or not, in certain cities. There are articles and calculators you can find where in certain cases it actually is not to your financial benefit to buy a home. But if you do, and that works out, instead of making rent payments, you're making your mortgage payments, and you're building equity over time, ideally. And you could also maybe get some tax breaks. Like I said, we're not tax advisors here, so I'll kind of gloss over that one, but it is possible. And it also helps you build your credit. So on-time payments on a loan of that size is going to be, good for your credit score. There we go. How are we doing on time, Megan?
We're good. You want me to take over here?
Yeah, you can talk about home loan options.
Hey, I wanted to also throw in one little thing about the question that was asked. One of the other resources we have if you have any type of loan product with us, is a skip a payment option, which is really helpful. We know there's been some the devastating fires right there in the LA area. We are doing things for our members that have had those disastrous events happen to them. So please reach out. There are resources for you that we can help you and to get up and back on your feet during these times. Okay, so home loan options. You have lots of different home loan options. I know sometimes when it says buying a home in California, how will I ever do that with the prices? But there are options out there for you. These are just different loan options. There's also first-time home buyer options that you can do. If you were in the military, explore those VA options. Many of them are zero down. A HELOC, this actually is an acronym, stands for a Home Equity Lines of Credit, which we offer. Right now we have a special, it's 5.99 for 6 months. So if you have a home and you want to pull out some of that equity to use for other things, that can be very helpful. A lot of people do that for tuition instead of taking out student loans. But it doesn't have to be used just for to improve your home. One of the great things we have at University Credit Union is we have a 5% rate on all of our products that we offer that are out there. Okay, step number 8, diversify. Don't put all of your eggs in one basket when it comes to savings or credit cards. Diversify what you do, your stocks, your financial counselors, but I always recommend using a certified financial planner to help you. They are two different things, and they are very qualified in the stocks, bonds, and cash. We have one on staff, Lucy, who Coley mentioned, and you don't have to be a member to get her advice to help you. I did want to share with you a little bit so you could see how the market has performed over the almost 100 years here. And, we don't control the market. The current inflation rate, if anybody knows that, as of January 2025, was 3%. And the Fed likes to keep it around 2%. It's been, it's cyclical. It goes up, it goes down. There are different things that you want to do depending on the inflation rate. For example, if inflation's low, prices fall. And that can actually lead to what we call deflation in the market. High inflation, that's a great time to invest in some real estate because real estate always pays off. Buying a car, not always so much. They depreciate, but houses and real estate tend to appreciate. A lot of people think I'll never get into a house. I always say, think outside the box. What if you had a roommate helping you with some of that? What if you went smaller and then worked up into a bigger house? So anything you can do to get into a home and diversify will help you in the long run. Coley talked about our savings. Savings are so important. Like she said, our high yield savings, I put the link in the chat, is earning 3.5%. I will tell you, every financial institution has a high yield savings. Read the fine print. We have fine print on ours as well. It needs to have a $2,500 minimum balance to start earning those dividends, which are paid monthly. And then they compound. So the next month you're getting a little bit more for that. Check what your savings rates are. And most people don't know what they are, but a typical savings account earns about 0.1 or even less than that. So they don't earn that much. Try to do a high yield savings that is out there. If you're able to, put it in something that will earn a little more, like a CD. Right now we have a 6-month CD that's paying 4%. Very easy to open. The 4-pointer certificate. And they change. These are promotional rates, so they will end. They will change. So always keep checking back with your financial institution, whether it's us, whoever it is, and see what they're offering. Money's sometimes something we set up and we have things direct depositing and auto paying, but do we ever go back and revisit it? Revisit it and see what is happening with it and what the new products are. Coley and I see it every day, so we're kind of like rate geeks and check all these things out. But I know most people don't look at it and don't ever take a look at that. Okay, step number 9, plan ahead. This is for the future. These are the topics that nobody ever likes to talk about. Making sure you have health insurance, disability, homeowners insurance. And then the big one is, of course, planning for your future, which is estate planning. And there are 3 documents that everybody should have on hand with them. One is a will or a trust or both. I always put those in the same category. You should have a power of attorney who will handle your affairs when you're no longer here. And you should also always have a healthcare directive. How do you want to be dealt with if you're in one of those situations? This really is a gift to your survivors, your children, your family members, your friends. It's already a devastating time when we have to come to these situations, and the more that you have prepped and prepared, the easier it is on all of the survivors. Again, not a fun topic to talk about, but there are a lot of great resources out there when you go to do this. And these are not easy documents to do on your own. So I always recommend get some professional advice when it comes to it. Set up all your accounts so they will be easy for whoever has to deal with that. And then finally, number 10, get some help. And I'll switch it back over to Coley.
Thanks, Megan. And I'll add to that last topic. I second getting at least beneficiaries on your account. That's something you can actually start the process of doing today. So even if, later tonight you want to send a message to your, financial institution online, or if you want to call them, just to get that process started, because that's just number 1, the first step that you can take today to help protect the people in your life from having to deal with a difficult situation. But yeah, step number 10, we've said this, and said this again, get help, seek the help of a professional. So your financial institution, financial planner, estate planners, you can learn on your own. So we, of course, have a bunch of different stuff on our website, a lot of information, calculators. You can use us, at will, email us if you have questions on something, seminars, search the internet, books and magazines, just check the sources and make sure that it's something that you trust, and always stay away from extremes, I guess, is my best advice. There are a lot of books out there by a lot of different people. Their styles may not match your own. And then I wanted to remind you guys and give you a QR code to book a virtual appointment. Our most popular appointment type probably right now is the financial wellness review, because you don't have to be a member. And it's, just easy to book an appointment. So membership not required. We give unbiased advice. If it's not something that, we can beat, we're not going to tell you to move it over, essentially. So if everything's looking good and you just want confirmation that your plan, is in place and everything's working for you. And then remember, we are certified credit union financial counselors. So we're not just winging it. We really care, and we've got the resources to back that up. And then just because we do talk about membership here and all the great benefits that we offer you at University Credit Union, I wanted to give you a little snapshot of how to open an account. Really easy. You just go to the ucu.org website and click open an account, or you can scan this QR code to become a member. And we wanted to leave you too with one of our favorite quotes that you'll hear all of us bankers saying all the time to each other, is that an investment in knowledge always pays the best interest. So the more you learn, the more you know, the more power you have, especially over your finances. And then we're going to leave it open for questions.
Definitely. Thank you so much, Megan and Coley, for being here and sharing these valuable tips towards financial success. Um, I would like to start. So, if attendees, if you would like to start putting your questions in the Q&A, I will start us off. Um, which of the 10 steps do you find most people struggle with, and how can they overcome it?
Ooh, that's a good question. Megan, do you have a favorite? I'm gonna
I do have a favorite. I was kind of want to know what yours is too. I think the hardest one is number four, living within your means, because we are marketed to so much in every aspect of our lives. From the moment we get in the car, we pick up our phone, we have all these things coming at us, and so getting real with yourself and living within your means, I think helps you solve the dealing with the debt and savings and getting to your goals. So if you can master four, you can really handle all the rest really well.
And then I'll say three. Four is also probably my biggest one, but step three, creating a spending plan and savings plan. Um, People just don't do that sometimes. If you,
Yeah.
you know, think back, just think to yourself, have I ever written down my financial goals? And that really surprises a lot of people when I ask that because you have them in your head. You just save whatever's left over at the end of the month. You haven't really planned out how much you need in case of the emergency. And so you're really setting yourself up for success if you're taking account of all of everything you have, making sure you have a plan for it. Money is too important and it's too important in your life.
Yeah.
Just kind of wing it.
Thank you, Coley. Another participant asked, most of their debt is educational debt, and what is some advice and or strategies that this person and the rest of our attendees can explore to making sure that they can still save and plan for the future, apart from applying from the PSLF? What are other strategies they can explore?
Great
Yeah.
question.
Yeah,
Um,
I was going to say, I actually have a webinar after this about student loans in 2025. And
Ooh.
actually, okay, so you guys can all register for that as well if you go to studentchoice.com. I'll find the link for you. And I'm sure they'll have some great tips. That's who we use when we're talking about refinancing student loan debt.
Mm-hmm.
So maybe I'll see you all there if you have another, the brain power left. But other than that, I would say make an appointment, um, online or visit, one of your local branches. Bring your statements if possible. We'll check out what the interest rate is. We'll talk about, whether you're in deferment or not, or what your future plans may be to, get rid of a portion of that through work. There's a changing political environment. So it's kind of a nuanced question. Depending, but we're really here to help you navigate that.
Thank you
and I,
so much.
And I'll add to that too as well. I always recommend students start at your accounting office at your university where you're at and make sure you have all the right information on all the loans. The one thing I will tell you not to do until you have consulted with them is do not do a refi on them yet. There are forgiveness programs out there, and the information on student loans changes so fast that what was gone one day is here today. And you may have heard something 3 months ago and it will be different. So it does take a little bit of navigating on those student loans, but start at the accounting office. And the Student Choice Workshop is a great one too.
Thank you, Megan. Lastly, do you have suggestions on where to find a financial planner to help advise on diversifying investments?
Yes. I will also link Lucy's information. You can make a virtual appointment for meeting with a financial advisor with University Credit Union. We say Lucy, Lucy, Lucy. That's our main contact, and she's fantastic.
She is
So
also, not to cut you off, she is also providing the fourth installment of investments on April 25th or 9th, and that will be on our website and in our newsletter as well. We're having her host.
Thank you, Heidi. Yeah, that's very important. So you'll get to meet her. She's fantastic, like I said, but we offer that service to non-members and members alike. Yeah.
And I was going to say a financial planner is kind of like a doctor. Find one
Mm.
that you connect with and that it's a good match for you. That may take a couple of times. I mean, we love our Lucy, but find one that you really love and ask friends and people that you know if they have one and go from there. But Lucy is great.
Well, any last questions from our participants? Thank you so much. Again, staff assembly will be having the recording on our website. And so if you want to refer to it, we welcome you to do so. And our next Learn at Lunch is March 25th. And we thank both Megan and Coley for being here. And
Thank you,
with that, we will